Hey guys, welcome back to Investing in Stocks for the Long Term. This is Tom. Today we're going to be taking a look at Unknown Market Wizards, Jack Schwager's new book, and it has Chris Camello in there. It's got Peter Brandt. Those are probably the most well-known traders of the book. Today I'm just going to be highlighting one trader, John Netto. He's unknown to me, certainly. He's a former Marine. We're going to look at him. And there's a few takeaways in relation to my own investment in GameStop. All right, so John Netto, he was not a good student. He was a bookie when he was in high school. He just informally, and he was able to make about $7,000 collecting from just people at the school. But then when 24 of the 28 favorites won one week, it threw him off, and so he ended up losing all that 7,000, and then I think he even had to borrow a little bit. He had the sort of some of the schemes and stuff even growing up, but it didn't always work out for him. This taught him about black swans, and taught him how you have to be careful about your risk. He knew he needed some discipline, so he decided to join the Marines. He said it helped him, obviously deal with setback, stress, accountability. And he learned Japanese. I think he may have had some kind of a desk job or something. He had some free time. Sometimes in the military that's the case. He started reading about trading. He read Joe DiNapoli's Fibonacci analysis, and that's primarily what he was doing. He was just a technical trader. Oh, first I will tell you, why do we need to care about this guy? He has a 42% annual return for 10 plus years. So that's a heck of a lot better than almost any trader, out there. So amazing returns. We'll learn a little bit more. So he turned 75,000 into 190,000. Okay. But after the tech stock crash, it went back down to basically 40,000. He was started to use a newsletter service. He didn't use stops. His position sizes were too large, and he got stopped out 6 times, and that was pretty much it. From 2003 to 2010, he said he did okay, but I don't think it was anything beating the market necessarily. Then he switched from just technicals to looking at the importance of prevailing market narrative, and that's the primary takeaway of this chapter. Looking at the prevailing market narrative. Now, what's an example? Okay, the S&P 500 right now yields more than the 5-year Treasury notes, so the market will likely keep going up. Sometimes the prevailing narrative, it's generally not something you want to be contrarian on if the prevailing narrative makes sense. That is, this is not a one size fits all formula. But anyway, for example, you've got 17 trillion of negative yield instruments. So it's hard to find yield on your money. Gold is, of course, no yield, but it's better than negative. So he says that explains the bull market in gold. So basically what these are events or headlines that could cause a short-term trading opportunity. Now, widely followed stories can sometimes get crowded and sometimes surprise people. His most profitable trade was when the Fed said interest rate decisions were going to be more based on data and not a certain amount of quantitative easing, whatever, buying the stuff per month. And that allowed him to, he saw that ahead of time. He had a prepared mind. It allowed him to take the trade and make hundreds of percent, I believe. And he's usually short term, sometimes just an hour or minutes. And now he says, be aware that forced selling can be a problem. This reminds me of Niederhofer, another famous speculator who blew up when he thought sure that the Russians wouldn't let their bonds default, and they ended up defaulting. And then so sometimes you have forced selling. Like if that trade blew up, then that might cause other people to sell in another market where it seemed like it was a sure thing. But if they needed money to cover losses in another area, then they might have to sell out of another market. So it reminds you about risk management and, realizing that there could be a black swan that you may not know about. So, his least profitable day, that's another thing to consider, is sometimes you get sell the news events or you get reversals, kind of these news reversals. For example, in the Gulf War, when we came in, started the war, the market had been down for a couple of years or sideways, and people thought, okay, this is bearish. Big war starting, whatever. Not a big war, but And so the missiles started coming down. He said, I'm going to short this. And he started shorting. And, it seemed like it was going to work at first. Then the market went against him. He started shorting more. Then the market went against him. He shorted more. Then the market went against him. He shorted more. He was basically on tilt. That's what the poker players call it. And, that's never a good place to be. You want to, when the market is going against you, especially in these short-term type of trades, you got to respect the market. And, he learned from that, certainly, how when you do get those reversals, for example, when Trump was elected, he talks about this, people thought the market's going to crash when Trump's elected. It didn't. And, if you continued to be short and to be pig-headed and going against that, some people did. And, that's important to remember. So the second takeaway is emotions. Some people say you should try to take your emotions out of trading. He thinks that's basically impossible. What he does is he uses his emotions as a contrarian indicator. So if he finds himself in a situation where he's like, oh, it's going up, I've got to get more size on, this is a can't lose thing, and he gets feeling euphoric, he's like, okay, I know it's time to sell. And that would be an example for me. GameStop. Okay, when we got the Microsoft revenue sharing, I thought, oh, the shorts are going to have to cover. This is going to be just great. And, I've got to buy more. We got to buy more. I should have used my emotions as a contrarian indicator and realized, hey, this is actually probably time to lighten up. Even though I am long-term bullish on GameStop, I think they are going to transition to more digital. I think they're doing the right things that they need to do in terms of shutting the stores down. Ryan Cohen just, is making a bid to take over the company, perhaps. He's the Chewy founder, so they're trying to move into e-commerce technology, get the digital revenue sharing, all that stuff. But you've got to respect the market and respect and use your emotions. Think about whenever you're that excited, probably it's a little bit too much. I could have gotten a better entry point if I'd sold out, waited for the pullback. Then I could have just relaxed and been in a better position here. So, Unknown Market Wizards, guys. Great book. I will be highlighting all the other traders in here. I plan on doing them all. So Chris Camello, obviously my favorite. He's going to probably be next. But there are a lot of other interesting guys in here too. Jeffrey Newman. So until next time, guys.